Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is June the 3rd, and we have Brent crude oil trading up again this morning. A little bit of a move upward. I suppose one might just call it little changed after what was a fairly significant move upwards yesterday, however, that one might have thought was a little bit counterintuitive to the news on the weekend that indeed the oil markets would have perhaps fallen yesterday, given the announcement by OPEC Plus on the weekend to continue with its accelerated supply increase. But of course, the opposite happened, and we had not only an average day up yesterday, but a fairly significant one. Let's kick off this morning with Livia Gallerati, Global Crude Lead at Energy Aspects, because, of course, she can explain it all. Livia, why are the markets moving upward, bullish and moving strongly yesterday? Your thoughts on that after OPEC Plus decided once again to raise supply in July by over 400,000 barrels, and yet prices rose and not fall. Your thoughts?
Thank you. There is a lot of reasons for that. I think first, leading to the announcement from the OPEC 8 group, there were some media reports and some experts who were actually calling for a larger increase than the 411 that they actually announced. So leading to the event, there were some in the market that positioned for a larger increase. So when the announcement came out with just the 3x, that has led to some short covering. So that's reason number one. And then, of course, yesterday there was a lot of other things that boosted prices. The market shifted again to look at what's happening in the geopolitics space, with limited progress both on Russia and Ukraine peace talks, as well as US and Iran talks. So there is very much a lot of focus on geopolitics at the moment. And then there is actually quite a lot of things happening on the supply side with potential risks to production in Canada from wildfires. There is more turmoil in Libya that highlights sort of the shaky situation there in terms of potential disruptions to exports. I could go on. I think the underlying thing is that inventories at the prompt are tight. That's why you've seen backwardation in the crude market sustains even through a period of peak refinery turnarounds. So even though the market agrees that come Q4, there is going to be very large stock builds and leading into 2026 as well, it's very hard to position for that at the moment, given how tight prompt markets are.
Let's welcome Arne Lohmann Rasmussen, Chief Analyst and Head of Research at Global Risk Management. Arne, I suppose in some ways we've been talking in recent weeks about this oil market sort of in search of a new North Star, that something that would shift it off of its, as we call it, $65 Brent barnacle on a rock. Ultimately, there's a lot of shaking, but we're still stuck at that despite the jump up yesterday, maybe more of a relief rally that OPEC Plus didn't go completely crazy. Your thoughts on where the market's at? What is it being guided by? What is its North Star, as we say?
Oh, it's a very good question. I think there's two events that can sort of move us away from this 65 handle or 60, 68 handle. On the upside, definitely if these sanctions, first of all, Iran, I think the market's become a bit complacent there. And then, of course, if there's actually tougher sanctions on Russia from the US, I'm afraid it's unlikely, but that is two main cases that are on the upside. Also, if the economy actually turns out better than expected, better than feared, in light of the trade war. On the downside, it's also the trade war. I think there is the market's become a bit too complacent that this will go well. We have the new deadlines approaching. We have Victor in the podcast today. What will we have a new standoff between the US and China? What about US, EU? We saw the ISM yesterday from the US from May. It was weaker. There was no relief to be seen there. I saw the Caixin PMI from China this morning for June, also on the weak side. This has definitely hurt the global manufacturing cycle quite significant. And we are in the stop and go economy at the moment. So that could break on the downside, of course, together with the OPEC Plus, and on the upside, that actually things go fine together with sanctions. So that definitely things out there, but maybe they are sort of balancing each other out at the moment, and that's why we are caught in this narrow range. Also, considering that other financial markets are actually doing quite well. Equity markets are performing. Oil is definitely underperforming there. And then something I'm looking a bit at. Remember, if you woke me up 10 years ago, and they said to me, over the night the dollar is 2% weaker. Okay, I would probably guess that the dollar was higher. Over the last 2 years, it's actually been different. Stronger dollar, higher oil price, because it's been related to strength of the US economy. I think there's something coming back there, that a weaker dollar actually starts to go hand in hand with a higher oil price. There's this move away from the US assets, the dollar, bonds, treasury, and so on. So maybe we're also getting a connection between weaker dollar, higher oil price. So that could also move us higher. There was a lot of moving parts here.
Yeah, I'm not sure there was a North Star in there anywhere, but we'll come
sorry
back to
about
that. We'll choose one. Victor Yang, Senior Analyst, JLC Network Technology, sitting in China, the ultimate North Star for the oil market. It's long lost lover, old North Star that the oil markets used to be able to depend on, and now fading into the distant galaxy. Is China still a North Star for the oil markets?
Well, when we look at the actual demand from China, we do not see much fluctuations, but there's been kind of concerns about supply this year, and even from the beginning of this year, when there was supply concerns about supply from Russia, from some other countries, particularly in the Middle East. And now these kind of concerns still exist. So some refiners could be buying more than they actually demand at present. And we already saw that in March and even in April, when there was a larger refinery maintenance in April. And now imports could still be larger than the actual demand because of such concerns. And we have seen escalation of conflicts in the Middle East. So Chinese people also pay a lot of attention to such escalations. And buyers who need to import goods from some other countries had such concerns too. Yeah.
And from the point of view of consumption, I mean, there's one thing that one would say from the sort of analogy, not to beat it to death, but nonetheless, China remains a pretty solid North Star for the oil markets. Imports have maintained at fairly 5-year average levels, 11 plus or minus million barrels a day.
Yeah.
But what about consumption?
Well, the actual consumption this year has kind of, edged down at the beginning of the year, but it rebounded later on because of the start of a new complex in Shandong. Say in 2024, the operating rates of Independence were higher than now, but with the startup of the new complex to 400 KBD, this has made up for the loss. So basically, when we look at the crude runs, they are stable, largely stable year on year now.
Livia, looking at the commentary on the expectation versus OPEC plus sort of counterintuitively increasing supply into what is a kind of a weak demand outlook. Energy Aspects is, to a certain extent, your head of research, Amrita, has been a little bit of a lone voice. She's actually thought OPEC, it's a good time for OPEC Plus to add barrels to the market, she said last week. And inevitably, everybody was expecting that they would continue with it, but that it was a good time to do so. Most analysts would say maybe not a great time, but Amrita was sort of signaling the other. Give us maybe some thinking around that from Energy Aspects point of view as to why this is a good time for OPEC Plus to be adding barrels.
Sure. And look, this ties back to what I was mentioning earlier about inventories being tight heading into summer. So even if you account for higher levels of production from OPEC Plus, you actually still get, at least in our balances, to stock draws in Q3. And to be honest, that would still be the case even if you get another increase in production in August. You only really start getting some builds from September. So this is why it's not necessarily a bad idea for OPEC to be bringing back production now, because the market can actually absorb it. Of course, the consideration is very different from Q4. And that's what the market is looking at, and we're showing the same in our balances, big supply-led builds in Q4. But until you get some sustained and very visible stock builds in the market, it's going to be very hard to shake off the backwardation in crude time spreads.
Arne, we're looking at some sort of significant developments amongst the list of little North Stars you mentioned earlier. One is, it seems, the surge of geopolitics back to the front, particularly after the weekend. It's hard to sort of separate each piece into its own impact, but it seems that obviously the OPEC Plus decision, the 8 countries as they're called, that decided to increase supply, but not by more than had been expected. So the market took that as a bit of a relief. But most notably, also the surprise over the weekend that one would have to point to as possibly impacting, it was the spectacular Ukrainian attack into Russia and the impact there, which sort of brought, that was probably the biggest surprise of the weekend, and hence the market move perhaps yesterday being the surprise. Do you connect those two together, and how big an event do you think this is vis-a-vis the overarching Russia-Ukraine peace deal, no peace deal, Trump being successful, not being successful, the whole geopolitical risk aspect of that?
I think it was, as you said, spectacular, and it shows that Ukraine still has some cards left. Remember, Trump said he didn't have any cards. Zelensky, they do. But we also saw the so-called peace negotiations yesterday in Istanbul. I think they lasted less than an hour. There's no peace deal. There's no truce in sight, in my view. And the question is, of course, for how many times can Trump continue to say, "I'll give them 2 more weeks"? I think he's said that 3 or 4 times now.
Well, lingering in the background is the threat of this Senate sanctions. This sort of 80 plus senators are ready to pounce at any moment with this great big bill that'll put a 500% tax on anybody who buys Russian oil. It's sort of like the boy who cried wolf at this stage.
Yeah, indeed. And I don't think it'll be put to a vote unless that Trump will sort of say in advance that he will support it. And I think if there will be sanctions, they will be watered down, because these are actually very, very severe sanctions. But sanction is not just about sanctions. Sanctions is also about compliance. We saw it in February, high compliance, for example, India being more scared of buying Russian oil. Then it seems to disappear. There's a lot of stories now.
And Iranian.
Yeah, probably also, and that the oil is now flowing again. So maybe if you just get back focusing on compliance, it will actually have an impact on the market. You do not necessarily need new sanctions. You could also lower the price cap. The US voted against that at the G7. it will not be a silver bullet. It will not solve everything, but it will put some pressure on. It will take some Russian oil away from the market. But I think the big elephant in the room here is really Iran on the sanction side, and it seems like it's almost changing by the day whether we will get a deal or whether we will not get a deal. But in my view, we are heading towards a breakup of negotiation, and eventually we'll see tougher sanctions on Iran. So geopolitics, in my view, is creeping into the oil price again. It's more or less been absent for the last couple of months, as I see it.
Victor, China's health, of course, is its economic health and well-being is a critical factor in the oil markets, and how severe or not it's being impacted by the tariff trade war, and even without that, the forecast at the beginning of the year was China was going to have a difficult year. I'm wondering what we can read into today's China's manufacturing activity in May shrank at its fastest pace since September 22, which is sort of deep in the COVID window, and that the S&P Global Manufacturing Purchasing Managers Index came in at 48.3, which indicates contraction. What do you read from that? How much should we read from that from the point of view of the structural weakness of the China economy this year?
Well, as we know, after Trump announced additional tariff in April, most orders from the United States were canceled. And Chinese companies who relied on export to the United States took a big shot from this tariff and their suspension of their orders. So we saw a significant decline in manufacturing in the second half of April and the first half of May. And after the United States and China signed an agreement on May 12th, the production surged. A lot of orders came back to China, and there was a vie for ships to be, for American goods, for goods towards American. And so we actually saw a rally in the second half of May. And most companies who are export-oriented took a shot at the beginning, but now they have basically recovered from such shocks, and they have been trying to find alternative markets such as Europe and Southeast Asian countries. So they are now like at the beginning of the additional tariff now. So we do not expect such a shrink to continue into June or April. Actually, we expect a significant rally in June.
A significant rally of what?
In manufacturing, yes.
To surge back. So after this May drop off, you expect because of the suspension of the tariffs, the elevated tariffs.
Yes.
So that would be the main reason.
Yes.
Okay, let's go to the survey question and get a view on the outlook for the second half of the year as to whether indeed, as Livia indicated there, that the most expect these supply increases to come to the sort of full impact in the second half of the year, where the imbalance, where oil supply exceeds demand in the second half of the year, will be quite notable. As we go out of the summer driving season in the US and so forth. I heard numbers mentioned last week on the stage at MPGC in Bahrain that excess could be as much as 1.5 million barrels a day, and I've included that in today's survey question. But how big do you think the oil supply will exceed demand in the second half of this year? 500,000 barrels a day, 1 million barrels a day, and whopping 1.5. or 4, no excess, that indeed there will be a balance. Which of those 4 do you think will materialize? Livia, one thing that has been mentioned, and Energy Aspects has been mentioning it, is the fact that inventories are relatively low in the context of it's a good time to be increasing supply, and the commentary from Amrita around that as well. What is the extent to that sort of inventory rebuild opportunity or absorption that the OPEC Plus and its sort of decision makers would be comfortable with, would be guided by before they might reverse their current trend?
I would say when it comes to what OPEC might do next, our base case is still that they will continue increasing production at the current 3x pace, so that accelerated.
So they'll get the whole 2.2 back in the market, basically.
Not necessarily. We think another increase in August is possible, potentially into September as well. Beyond that, it will be more challenging because of what we're looking at for fourth quarter stock builds on a global basis. Of course, it's still very early to say for certain, and we're watching any kind of messaging from the group on a daily basis to see how that decision shifts. But again, we're still looking at stock draws in Q3 that continues into August as well. So the market could potentially absorb more OPEC production in the near term. Now, in terms of what that H2 2025 stocks profile looks like, I would say your average for the second half of the year in our balances is probably around 1 million. That's because you get larger than that stock builds in Q4, but you have stock draws in Q3, so that kind of averages out. It is important to remember, though, that in the first half of this year, we actually built much less than the seasonal average. Typically, H1, you get builds because of refinery turnarounds. So you do have a low starting point. So again, that's really one of the reasons why you're still seeing backwardation in the market. I think that's a really important thing. Like just yesterday, WTI was above $1. I mean, still this morning, Brent is ranging between 70 and 80 cents. Backwardation, like those are clear signs that tell you that the market is stressed at the prompt. I think that is not to say that we're not expecting any downside in the coming months. We've talked about the risk related to the escalating trade war between US and China, and we were even talking about it before the podcast started recording. And I think there's a lot of complacency in the market thinking that this is the end of it, and that
the end of
tariffs.
Right. We've seen the sort of high water mark, and we're now in the time of
exactly.
What is it? The taco that Trump eventually backs out of everything and won't face off China on this.
And we disagree. There's tariffs are such a central policy for the Trump administration,
particularly around steel. It looks like is a big one.
Yeah, and look, the sectoral tariffs haven't gone away. It's the reciprocal tariffs that might, but we think there is other ways for the Trump administration to implement them, even if this a ruling from the International Trade Court were to go ahead, which has been appealed anyway. We're waiting this week to see what the evidence provided by the various parties is. So yes, downside to demand is still there. Eventually OPEC supply will start adding to the market. So there is more downside to prices to be had. It's just difficult to see that in the very near term.
Arne, one of the consistent themes this year from the last days of the Biden administration right through to yesterday, and that was the continuous sort of restriction on shipping. There was continuous efforts to clip the sort of dark fleet, the gray fleet that have been facilitating all of this sanctioned oil. And yesterday, the Panama authorities, the world's biggest flagged fleet, if you like, with some 8,000 ships carrying the Panama flag, they removed 650 of them from its register, sort of deflagged them, if you like. Your thoughts on where the restriction, the containment on shipping, its impact? You've said in your earlier commentary that sanctions have always sort of been got around, if you like. Where do you think this continuous effort on shipping is having impact, and how is that translating through to price?
As I said before, I think this is very much about fear of sanctions, and I think the fear of sanctions is relatively low at the moment. Yes, it has an impact, but the shadow fleet is still there. It's sailing. You even have the vessels going without any flag now. We know it very well. I'm sitting normally in Copenhagen, can almost watch the oil tankers going past. You cannot stop them, even though there's no flag, even though it's obvious this is an environmental disaster waiting to happen. But yes, it has an impact, and you could also lower as I mentioned, the price cap. It will remove some of the legal possibilities there. But for shipping, of course, also important, and for bunker for fuel demand. What happens with the Red Sea? We had the peace deal between the Houthis and the US. It hasn't really reopened the Red Sea. There's a few more vessels going through, but you're still going around the Cape, around Africa. Most say that's probably adds some 5% to global bunker demand. That's also why we're seeing, for example, that this high sulfur fuel oil, the really heavy stuff, is quite expensive. There's a big demand there. Actually, something which we are looking relatively closely into is whether especially the Saudi Arabia is going to burn more crude this year instead of fuel oil, because that could really have an impact on that spread, but it could also have an impact on the flat price for crude oil. I don't know if Livia have any views here, but switching to crude oil burn could probably take away some of the extra barrels.
Power generation over the summer for the excess,
exactly,
sort of elevated demand for air conditioning.
Back to the shipping question.
Yeah,
you need even tighter sanctions. You need sanctions that people see that the EU, the US are actually targeting a high compliance before we'll have any major effect. Just the last 3 years has shown that Russia gets its oil out, Iran gets its oil out.
Well, it certainly will be a big indicator if indeed there is any movement in the Senate. I think the skeptical view is just because they're not going to cross Trump on that. At least the Republicans aren't. But at some point, Trump starts to look a bit like a chump, if you like, in front of Putin, as he keeps calling his bluff, and Trump doesn't do anything. That's going to be a big question. Victor, last word with you. The idea of what does the tariff war feel like from a China point of view? Does it? The Chinese leadership have played it quite well so far, you would say. They've done nothing. I mean, they've raised tariffs, but they haven't really given much to the Trump administration, and the Trump administration keeps coming their direction, it seems. But is this a face-off, do you think, that will, as Livia's indicated, worth keeping an eye on, because it's not going to go away? Does it feel like this is going to last in China?
Well, we do not see it going away anytime soon. We know there's a 3-month suspension, but during these 3 months, both parties will need to negotiate on trade between the two countries. And we can see more, negotiations and the fight the competition between them will continue. And in China, most people would think the country did it well. Actually, there's no way if we just budget. So China in the face of such tariff, we knew at the beginning it would be more difficult, particularly for a short period of time. But there is no way for China to say, well, let's compromise. I will do whatever you want, and let's remove the tariff. There's no way. So we knew at the beginning, but there's no going away. No other way around this. Yes, right.
Yeah, we're all sort of living, I think, in a little bit of this suspended slumber, if you like. The survey question, at least, is indicating here that 1 million barrels of excess supply over demand in the second half of the year is getting most attention. A number of things to play out, and it seems that as Arne mentioned, the Iran talks were from their beginning urgent. They had to be decided immediately, and that was very much the Trump Washington idea. There was a 2-month, I think, deadline, and if everything, the letter that was written, and we're kind of getting to that now. Is there a big consequence? At least the original idea was that there would be, but I think the Iranians might be feeling out where the limits on that are. The urgency of some of these events will come to fruition in the coming weeks, at least as guided by those who are leading them, including the suspended sanctions, which are the first, not the China ones, but everybody else, are due to expire the 90 days at the end of June. So a few weeks for 140 countries to come up with new trade agreements. Those things can take years, never mind for one country. So it all seems a little bit fantastical. How does it resolve? That's the question. Livia Gallerati, thank you so much. Wonderful to have you as always. Arne Lohmann Rasmussen from wonderful Copenhagen. Thank you so much. And Victor Yang, of course, from China, a critical voice every time we have you at the table. Thank you so much. Have a great week, everybody. All the best.
Bye.
Have a great week.
Thank you.